This week's mortgage market tells a familiar story. Rates are moving, but not all in the same direction. Some lenders are pushing pricing lower, others are quietly increasing rates, and affordability has been improved in ways that won't always make the headlines. The key message this week is simple. Waiting for certainty in this market could cost you options. Let's run through what's actually changed and what it means for homeowners and buyers right now. Starting with mortgage rates, we've seen several lenders this week making changes. Some are more notable than others. Nationwide, for example, are now coming in at the top end of the pricing tables with some rates around the 3.5% mark. But at the same time, other lenders have increased rates, which reinforces a point that we've made repeatedly. This is not a uniform market, and there are no guarantees that rates will keep falling across the board. Now, just a reminder that if you want live news on when lenders change their rates, you need to follow me on Instagram. The profile name should be shown on screen, and I will put a link in the video description below, because the minute the news lands in my inbox, I share it in my Instagram stories, so you can get up-to-date rate details right there. So looking at swap rates, once again, just like last week, there has been very little movement. They're broadly flat, which explains why we haven't seen widespread pricing shifts from lenders. The changes that we are seeing from lenders are less about swap rates and more about market positioning and the new year lending targets. Because sometimes lenders make changes based on business decisions such as targets and customer service. Moving on, and this is where, in my opinion, things start to get interesting. So several lenders have made meaningful criteria changes this week, and in many ways these matter just as much as the rate headlines, in some cases more so. Principality have increased the maximum loan to value for interest-only mortgages from 50 to 75%. Now that's a significant shift for borrowers who need flexibility in how they structure their borrowing. Bank of Ireland have increased income multiples on their bespoke range. They're now offering up to 6 times income, subject to criteria of course. And that's a clear signal of lenders leaning back into helping people get on and move up the property ladder. April mortgages have improved criteria for borrowers over the age of 50, which expands options for people that are borrowing money later in life. If you couple that with their longer term fixed rates, and here we have a lender that really is all about innovation. And Principality have also improved their affordability assessment, meaning some buyers, including first-time buyers, could potentially borrow up to 20% more than previously. Now, these changes are the sort that won't always make front page news, simply because all people seem to be concerned about is interest rates. But they can materially change what someone is able to do, and so in my opinion, these stories are far more important than those rate headlines. Turning to the wider picture, the UK economy grew by 0.1% in the 3 months to November 2025, with growth of 0.3% in November alone. Now, every month when these figures are shared, there is always a revision, so their reliability is always up for debate, as is the message that they are sending. What's far clearer is this: households and businesses are not feeling that growth. Confidence remains fragile, finances are stretched, and spending is cautious. In essence, this data does support the case for interest rates from the Bank of England to come down. But with the economy bumping along rather than booming, the Bank of England is likely to move slowly and cautiously. No sudden drops, no straight line forecasts. So what does all this mean in practical terms? Well, for first-time buyers, lender innovation is improving borrowing power for now, but affordability is not guaranteed to keep getting easier. Therefore, securing clarity could mean accessing options that don't exist later. For home movers, borrowing capacity and product choice now matters just as much as the headline rate. And criteria and policy changes can be the difference between moving or waiting another year. For people that need to remortgage, the risk right now is delay. We've already seen a lender that was previously offering the lowest rates increase them this week. That alone should be a warning. Now, there is a growing misconception that mortgage rates will simply keep falling and that waiting until the last minute is harmless. Well, let me tell you, it isn't. Rates do not move in one direction, and lenders can and do reprice quickly, as we've seen this week. Therefore, securing a rate early gives you control and protection, even if rates improve later. Waiting, on the other hand, removes both. The key message this week is planning. Whether you're a first-time buyer, moving home, or remortgaging, speak to a broker as early as you possibly can. Understand how much you can borrow, what your options really look like, and whether small changes now could bring your plans forward, because you might actually be surprised by what's already available. That's your UK mortgage market briefing for this week. Thank you for watching. I'll see you next week, but for now, take care.